截至8月18日一周，美股市场出现了连续多日的回调现象。在本周三的时候，美联储发布了7月份的会议纪要，称目前通胀仍旧存在上行风险，之后可能继续紧缩货币政策是有必要的。该消息一出之后呢，美股市场连续遭遇了多日的回调。另一方面，美国国债收益率飙升，10年期的美国国债以及30年期的美国国债收益率都创下了多年以来的最高点。那么市场是如何看待美联储称所谓的通胀上行风险的？另一方面，在企业财报陆续发布进入尾声之后，投资人最大的收获又是什么？那美联储暗示会继续加息之后，市场的反应又是如何的？在纽约时间的8月18日，直击华尔街栏目邀请到了纳斯达克的高级分析师 Massud Ghaussy 来跟我们谈一谈目前他对于美联储政策的解析，以及对于市场回调的看法。Hi, thank you so much for joining us.
Hi, Rui. Thank you for having me on your show.
Sure.
Glad to be here.
Of course. So the first question, because in the past week, we've seen the U.S. Treasury bonds keep raising. At the same time, the U.S. stock market has dropped dramatically. So what are your current views on the stock market, and do you see any particular trends?
Yeah, sure. So let me take a step back and paint the economic and the market landscape that will help put things into context for our conversation today. Over the last year and a half, the markets have been traveling a lot, but it hasn't gone anywhere. If you look at the major market indices, it's flat to slightly lower over the last year and a half. Market narratives have been shifting very quickly. Investors are digesting a lot, and they have also been very reluctant to deploy capital. And the reason being, there are a lot of cross currents in the markets. There's just a lot to digest. First of all, you have inflation that has spiked all the way up to 9%, has come down to 3%. Still some work needs to be left to bring that to 2%, where the Fed is actually solving for. So you've got inflation. 2, the Fed's reaction to the CPI numbers, because obviously interest rates impact the stock market and the bond markets and pretty much all asset classes. And we have also witnessed one of the most aggressive and robust tightening cycles in modern history, and that has an impact on asset prices. So that's 2. 3, the macroeconomic environment. For months, we have been talking about a recession. It hasn't really materialized, potentially in 2024. If you look at various forecasters, there's odds of a recession are anywhere between 0% to 100%, depending on who you talk to. So there's a wide ranging of views. There's a lot of uncertainty. So that's 3, the macroeconomic backdrop. 4, earnings. Earnings obviously impact stock prices, and currently we're in an earnings recession. And for a sustained rally, we need earnings to improve. So those are the current 4 drivers in the market and has been over the last year and a half. And macroeconomic forces have had a significant impact on the stock market and the bond markets. Now, to answer your question about the last 1 or 2 weeks, actually 3 weeks, we saw a pretty impressive rally in Q2 in the equity markets. It began with the technology sector. It was on narrow market breadth, and then it started widening. As soon as it started widening, we started seeing Treasury yields spike, and markets started to fall. So that's currently where we are with respect to the markets.
You just mentioned about the Federal Reserve's monetary policy, and in their July's meeting, they just announced a 25 basis points interest rate hike. So do you still think they will keep interest rate the same in September's meeting? What is your viewpoint on their next monetary policy decision?
Sure. So I personally don't have a view, but I'll tell you what the markets are looking at. For September, there's, I think, approximately a 10% chance of a rate hike. For the December, for 2023, there's approximately a 30% chance of another rate hike. But more importantly, in 2024, the markets are expecting the Fed to cut rates. And that's because of a potential economic weakness, which will force the Fed to cut their rates. Also, potentially some political pressure ahead of elections in order to cut rates. Now, what we know is that the Fed has been signaling and messaging to the markets for almost a year now that they will be keeping rates higher for longer, and that obviously has an impact on the market, and the markets are starting to finally catch up to that, and that's why we're seeing I guess a correction now. The technology sector is down almost 10% today from its peak, so that obviously has an impact. Secondly, the Fed has also mentioned that they are that there's potential, they're not pricing in a recession in 2024. So they are generally positive about the state of the economy. Three, the monetary policy generally works in lags. It takes time for monetary policy to impact the markets, and this we have seen throughout history. And when you go through the Fed's minutes, which was released yesterday, there's a lot of uncertainty as to what the impact of this monetary tightening is. Again, earlier I mentioned that we have embarked on one of the most aggressive rate hikes in modern history, and no one really knows what it will impact and how that will impact. In March, we saw a mini banking crisis, which was also as a result of higher rates, and how these rates will manifest itself in the economy, in the markets, is yet still to be seen. And that's probably one reason the markets are forecasting for the Fed to lower rates in 2024 because of some potential event, some credit event that will happen down the line. We saw it during the great financial crisis in 2008. We saw it during the internet bubble too. In that when central bankers pump liquidity into the system, they never know what they're going to inflate. And when they take back liquidity and start monetary tightening, we don't know what they will end up breaking.
So you just mentioned, like we have seen in the March, the banking has experienced a crisis, right? So recently we've seen some similar events. For example, Moody's downgraded 10 US small to mid-sized banks ratings. At the same time, Fitch ratings also dropped US government's credit ratings from AAA to AA+. So what impact does this have on the stock market? Do you think the banking crisis is still not over yet?
So to begin with the Moody's downgrade of U.S. Sovereign debt, the last time we saw a downgrade was in 2011. Markets fell, the VIX volatility index spiked, and treasuries actually rallied, but it was a completely different environment because monetary policy was very accommodative back then, and we also had a sovereign credit crisis in Europe. So investors were flocking to the U.S. debt markets. Completely different environment now. And we don't have a lot of precedent, so it's very hard to project forward how that downgrade will impact the economy or the markets. But what I can say is I think it's a warning shot in that loose fiscal policy, aggressive government spending in order to pump the economy will ultimately lead to inflationary pressure. And this means over the long run, yields will climb. We saw similar patterns in the 70s and the 80s and also 90s in which the bond vigilantes came in, pushed up yields, and this obviously impacted the stock market because the cost of capital starts rising. Your second question about the banking crisis, whether it's over or not, it's a tough call. I don't have the answer, but potentially, again, no one knows how the rise in interest rates will impact the economy, the banking sector, and other income sectors or sectors that are sensitive to interest rates. So perhaps it is done, perhaps it's not. Investors are worried about potential next credit event, and specifically it's potentially the commercial real estate market in the US, which investors are eyeing.
I see. Thank you so much for sharing your opinions on the banking sector. Let's move forward to the technology sector, because Nasdaq, as we all know, is the home of technology. A lot of technology-related companies choose to be listed here. So you just mentioned technology sector has down for almost 10% from its peak. So do you think what is the performance of technology sector in the second half of 2023? Do you still think AI will be the driving force?
So I'm not in the business of projections, but what I can tell you is the technology sector, the reason why we saw a rally earlier this year was two reasons why. One, as you mentioned, AI, the AI frenzy. All of a sudden, investors were relieved that there is a catalyst out there, especially AI, driving the sector higher. That's one. Two, the technology sector started rallying because of disinflation. Interest rates, it peaked in October 2023. That gave ammunition for the technology sector to rally because the technology sector is very sensitive to yields as it's a growth sector. Its cash flows are further out in the distant. It's a long duration stock. So as a result, when interest rates started stabilizing and started dropping a little bit, especially during the March banking crisis, this enabled, together with AI, this enabled the technology sector to rally. And investors were very focused, and on very narrow breath, we started seeing the market rally based off the technology sector. You mentioned AI. AI, initially, the rally was based on a hype. This will take a while until it trickles into earnings, because what we need to see is productivity gains resulting from AI manifesting itself into earnings. And I don't think this is just a technology story. This is going to be a story across the entire market, just like how the internet revolutionized just our society in general, and it's been touching every single company. AI will most likely touch every single company. If you look at earnings calls across the entire sector, there's been an explosive growth in management teams focused on AI and how to bring those productivity gains into their workflow, work stream, in order to expand margins and drive revenues.
So let's move to the last question we have here, which is about the earnings seasons, because right now we're approaching the end of the Q2 financial reports, company earning reports season. What are the major takeaways for investors? Do you observe any red flags or any positive signs that investors should be aware of?
Absolutely. There are four things based on reading transcripts and investors' reactions. When it comes to transcripts, one, AI, as mentioned earlier, is a major theme across earnings calls, as mentioned earlier, and explosive growth. So how that will impact all companies, not technology, going forward, one. Two, the macroeconomic environment. On almost every single call, investor relation teams and also management teams are generally concerned about the state of the economy, and they're having a tough time navigating all the cross currents. So that's the second major theme in earnings. The third major theme is sales growth and also margin expansion. As mentioned earlier, we're currently in an earnings recession, so how to turn that around and how to expand margins and how to drive revenue is the next topic for a lot of management teams. Finally, from an investor market standpoint, we are in an earnings recession. It's interesting that there's a disconnect between the rally that we saw earlier this year, Q2 and early Q3, and the disconnect between earnings, because the earnings are in a recession. It's very odd that there's a disparity there. So investors will gain much more comfort once the earnings turn, once earnings grow again and margins expand again, and that will provide a framework for the markets to continue to rally and be in a sustained rally environment.